Well, good morning everybody, and thank you for your time this morning. I thought it would be useful today to go through, before the strategy that we operate, a recap on why you may want to think about having a more cautious approach to the core part of your portfolio. Particularly given something Alistair mentioned earlier, which is the move from people retiring at a certain date to actually retiring early in a staged basis, and also thinking about how that may impact their retirement pot overall in those variety of different aspects, whether it be within ISAs, in your company pension schemes, or your direct investments. But I thought let's go back to just the concept first of all. And you mentioned earlier, a gentleman here, about wanting to have some illustration about the concept, not necessarily the nuts and bolts of what's happening in the strategy. Certainly our marketing team is about to put out some animated descriptions of what the fund delivers and why it's aiming to take the approach it does take. But let's use that same concept here to say, what are we trying to achieve? Why would you want to even think about an outcome-focused approach to delivering your retirement pot over the longer term? So your clients typically have a focus, a target they're trying to deliver, that point A on the slide here you can see. And that dotted line is their path they'd ideally like to take. But a traditional approach, if you look at where they may be now, so they're at 50 years of age, maybe to get them to this spot here if they're taking a traditional approach to investing. A better approach, if you try and look at a focused outcome approach, will give you that smoother profile of that return. And the reason for that, it may get you to the same objective, same place at the moment, is that if you think about if that's where they are now, but they actually want to get to retirement in 10, 15 years' time, what's the impact if they get to point C when they actually need to retire? So this type of approach is really relevant, we think, in terms of saving for retirement, but also once you're in retirement and when you're looking at the drawdown stage as well. Now let's just think about that in concept. If you were at those different points, once you've got that retirement pot and you're in your drawdown phase, well, that's your profile you'd like to achieve. So the question is, how can you get that smoother profile over time to really draw down to how long you think you need to have that retirement pot in place? If you're at point B at the moment, or if you had to retire, okay, you may have a shortfall there, but again, you want to make sure you can have that smoother return profile over time to make that retirement pot last out. The concern becomes if you're at point C, then that could be the issue your clients are facing. Have they got enough time to continue investing into their retirement pot? Can it actually last them through? That's the why behind taking an outcome-focused approach that I wanted to go through today. So perhaps let's look through, and I wanted to start with something which is very simple, but it must be a starting point to say, let's stop deluding ourselves about risk versus uncertainty. So risk is something which we can look at and say, what different asset classes can deliver different returns? What's the historic correlation of those asset classes? What's the volatility of them been? That's a statistical measure. And if you were to construct a portfolio saying, well, we'll look at those historic returns, correlations and volatility to construct our portfolio, well, that's really not considering what the major risk is, which is uncertainty. What if things change in the environment? What if the impact on therefore the future returns of different asset classes changes? That's what we need to be thinking about when you're constructing a portfolio, not just what's happened in the past and therefore what you may want to use as your inputs into a strategic asset allocation model. Not the industry norm approach. I recognise there's a lot of challenges in terms of the philosophical point of view, but I think that's a much better starting point to recognise there is uncertainty in the environment, and therefore how do you then construct a portfolio and be very active in managing that portfolio to try and deliver that outcome that clients are looking for. So let's go through a few different aspects. First of all, start off with what you could expect to see within this type of portfolio. This is what I'd say is true diversification. Exposures in a variety of different asset classes, whether they be your traditional asset classes, your equity or your fixed income exposures, or your less traditional exposures like real assets. But also you think about the characteristics of returns you may want to capture, which are not just reliant on markets being positive to deliver the returns that you're seeking. So that's a really true diversified opportunity set to try and capture. That's what we look at when we're trying to invest for this global absolute return fund. The question then becomes, how do you manage those? So again, you don't just want to think about having a static asset allocation, but how much equity exposure do you want at different points in time? How much different type of fixed income exposure do you want? And how can you generate returns which are less or not reliant on the overall market direction, what I'll call here total return strategies. At the bottom left of that screen you can see there. But let's move through those one by one. First of all, having an active approach means you need to think about what the environment is, and it takes conviction at different points in time. Now, if you think back to probably one of the most stressed environments we've seen in the last few decades, the financial crisis in 2008, and let's just look through what that may look like in practice. So what I'm going to show you on the left-hand axis is the level of equity exposure in the strategy that we operate. On the right-hand axis is the level of the global equity market. So in terms of the actual lines that you'll see come up, if they work, the darker green line is the level of equity exposure, the lighter green line is the level of the global equity market. And if we were to look back at the period coming up to the financial crisis, we entered that period with about 50% equity exposure. But importantly, rather than just looking at what equities are delivered in the past, the consideration then is how are things changing? So our assessment of financial conditions around the world, the ability of companies to raise capital, to grow or just operate their businesses, those conditions were really just starting to go through the roof to say it's becoming extremely difficult for companies to raise capital. Their cost of business is going up. Our outlook around the world, the global growth outlook, was starting to fall off a cliff to say this is a really challenging environment for equities. And also, if you look at the level of the equity market, you can see it's already been falling, so our tolerance for loss has been coming down. And so in that situation, you need to say, well, actually, we need to take down the exposure to equities. This is not a conducive environment to have equity exposure in the portfolio. And so what we did in the first half of 2008 is take that equity exposure down. But taking that down to the level you can see there is quite a marked decision. So it requires conviction to have this type of approach. But it's about forward-looking exposures rather than just looking at what investments have delivered in the past. Now, conversely, if you look at what happened at the end of 2008, start of 2009, we need to think of those same factors again. Valuations, first of all. You already heard the prior speaker talking about valuations. Valuations matter most at extremes, either extremely expensive or extremely cheap. Then the forward returns are far greater. And at this point in time, we'd seen quite a significant fall in the equity markets. Valuations were starting to look extremely cheap. Importantly, though, the global growth outlook was starting to change. The amounts that governments and central banks around the world were starting to do to try and stave off depression at this point in time was quite significant. And then the other factor the prior presenter talked about was thinking about other investors, what they're doing. The amount of money which had come out of markets and was sat in cash in the first quarter of 2009 was again significant, but that was starting to go back into the equity markets. Another supportive factor for a rally in the markets, and therefore, if you think about our exposure changes, we took that exposure up quite markedly in 2009 and 2010 to capture a very strong rising market. But just one illustration of the types of things to think about when questioning your managers about where they may be taking positions and why they're taking those positions. Now, if you think about how that affects other asset classes as well, that's one of the components I mentioned, that is equity exposure, but look at, say, our portfolio over the last 5-6 years, and you can see how that's changed over time. So a dynamic approach is needed for this type of outcome-focused strategy. And even if you look at periods like what we call the taper tantrum in 2013, so about 2/3 of the way across the screen, if you look at that red area, you can see that's the net cash in the strategy. Went to 40%. So at points in time where you're seeing real challenges for all variety of different asset classes, that's when you want to take exposure out of a portfolio to try and limit the drawdowns you can experience for clients. So a dynamic approach is needed to managing assets as well. But then I wanted to talk a bit more, not just about asset allocation or your traditional exposures of equities and fixed income, but what about different, less traditional exposures? The first of which is infrastructure. We like to look at infrastructure, which is a real asset, because it has some attractive characteristics. It has an inflation linkage within it. You have some very real asset backing, you have some stable cash flows coming through. But when I talk about infrastructure, the type of infrastructure that we like is the likes of investing in the management of hospitals and schools and prisons. Very boring assets, but very attractive in terms of the profiles that you can capture. But that's very easy to say, and you can see some examples there, but the question then becomes, what parts of infrastructure are you really trying to capture and why? And that's important because which infrastructure exposure does impact how it would fit within a portfolio and what you're trying to capture. The reason being that a lot of infrastructure assets are very highly sensitive to the economic cycle. And that's not really what you want from a stable part of a portfolio. And just to put that into practice and show you what that means, it means you need to focus on certain parts of the assets. It's not just about getting a broad market exposure in this type of area. Because if we take, for example, the return profile of one of the main global listed infrastructure indices, the Macquarie Global Infrastructure Index, You can see the periods like 2011 where you had the sovereign crisis in Europe, and indeed the most recent pullback in markets. You can see that that is quite a volatile return profile. Same for the S&P global listed infrastructure. And then when you put on top of that global equities, you see that actually this is giving very much a global equity type exposure. So it's not really giving that diversification that you may have originally sought when your clients were saying, can I have a diversified portfolio with different assets underlying it? And just to highlight the prior slide, I mentioned I want to have some different characteristics. That's the return profile from our infrastructure exposure. Much less volatile, much more stable. It's not going to shoot the lights out, but we're trying to deliver a core portfolio, a more stable return profile over time. Just to bring that into context, if you look at the beta, so the relationship to global equities and how much those indices move relative to global equities, if it's a 1, that's a 1-for-1 move with the global equity market. And you can see on the right-hand side of that screen there, those two indices are very linked to the global equity market. So not really offering a true diversification, which is why you need to think about the specific characteristics if you're investing here. Now that's how you look at asset class exposure, but what about capturing investments which are less or not reliant on market direction overall? So some of the concepts that we use, I'll talk you through the concepts of these. First of all, a range-bound strategy. What do I mean by that? If you think about most investments, they rely on an investment going up, a market going up to deliver growth for your clients. But what if you could say, I think an asset is going to trade within a certain range over a specified period of time, or can we capture a positive return from that? And so that's what you're trying to capture. If an asset stays within that range, then we can capture a positive return in some of the strategies we use. Now there's risk in that, which is if it actually breaks out of that range, then we can potentially lose money, but that's the active management of this type of strategy. Conversely, if you have an asset which has been trading within a range, and you think it will break out either positively or negatively, can you capture a positive return from that investment? But give yourself a buffer, which means if it doesn't break out of that range, then you're not worse off. So it's not just taking a 1-for-1 investment with the market. Now, an example of that, if you think about an investment where you say it's been trading within a range and you think it will fall in value, can you capture a positive return from that? So in effect, you're selling that asset, but you want to have that buffer to make sure that if your view doesn't eventuate, then you have some protection there. Well, that's the type of strategy where the green area, shaded, gives you that return, that positive return from an asset falling in value. Again, the red area shows you have risk in these type of strategies if you get the view wrong. And conversely, if you think about the asset being within the range and you think it will start to act positively, one element of what we do is similar to what we heard in the prior presenter. If you think something hasn't been trading very well, but it will break out and it will have a positive return, how can you capture the upside, but give yourself an element of protection if that view is incorrect? And a final area I thought I'd mention is what we call relative value strategies. Again, another incremental part of what we do, which says if you have two assets that are very similar and you think that one will perform better than the other, can you capture a divergence between the two? Whether they're rising or falling isn't what you focus on, it's just a divergence between the two. So you're less reliant on the overall market direction. An example of that, if you think about buying one equity market and selling another equity market, and they're both rising, can you capture that divergence? Can you capture a profit if they're both rising, but one rises more than the other? The importance then is that type of strategy also works in a falling market. So it's not whether the market's rising or falling, it's just that divergence between the two. That's really an attractive characteristic you may want to capture within this type of core portfolio. And also that's the theory, but it's also a practical example. Now that's a live position we had in the portfolio back in 2012. We were owning US equities and we'd sold European equities, and this is when we had the sovereign crisis when Portugal asked for help in March of that year, and then we saw the markets had been rising and fell dramatically. They fell at a sharper rate than they did in the financial crisis. But this type of position can still generate positive returns in a rising and a falling market environment. So some concepts of what we try and capture in this strategy. Does it work in practice? This is the longer term return. We've been managing this strategy since 2004. That dotted blue line, that's the 4% above cash on an annualized basis. That's the long-term return you can expect to get from equities. That's what we're trying to deliver, a much smoother return profile. On the right-hand side, you can see the risk and return characteristics there. So we've delivered slightly ahead of equities over that period, but with a much smoother profile, about 40% of the volatility. And just to plot those lines on there, that's the global equity market. Clearly, if your clients had been invested from 2004, they would have had that significant fall in the financial crisis, a very volatile ride. Can you imagine talking to your clients in 2008 saying you now need to retire and your pot's down 50%? The aim of this type of strategy is to make sure you don't have that type of conversation with your clients, and that's the return profile we've been able to deliver. So thank you for your time today. I hope that's been useful and interesting. I will be around later to take any questions. I think we now need to hand over, but also time for one question maybe.
Yeah, sure, cool.
Yes?
What's the risk profile when you look at it, say, from 1 to 10?
It depends on the individual risk profile. So our SRRI from a 1 to 7 scale is on a 5, but it depends on the actual risk profile itself. If you look at another for
Old mutual, say?
I wouldn't know. That would be down to our sales team in terms of where their profiling is. So I'm focused on what we're trying to deliver, which is the return objective within that volatility profile. So global equity return, cash plus 4% per annum, with the volatility less than half of the global equity market.
Go on, sir.
Just wondering, you've got a nice smooth return, but in the sort of savings for retirement, you can actually make money out of volatility because you're buying, you're pound cost averaging and all that sort of thing. How much, have you done any figures to show how much you'd have to save to get to the same place on a monthly basis?
I haven't personally, no. I'm focused on delivering that return profile over time, so you can in effect put that money in at any point in time. But also when you're in retirement and you haven't got that ability to add more in there, this is very relevant because then you're trying to make sure you can maintain that position over time rather than having a short-term setback.
Right, so it's more for that than getting there?
It can be both. We can see the longer term you can deliver that return profile over time, and also once you're there as well, it's important once you're in retirement, yeah.
Thank you very much. Plenty of opportunity later on as well to ask questions, so I'm sure there will be some as well. Thank you very much.